And of course, it was as big as it could get over the weekend when the Central Bank Governor, Godwin Emefiele, harvested the thoughts and ideas of business leaders and policymakers here in Lagos for his next 5-year agenda. He says early last week, that he will consult with industry stakeholders on what should be, what their thoughts are about his next 5 years in office. So they all put heads together, a very major for several hours here in Lagos over the weekend. So let's take a quick listen to what the Central Bank chief told his audience, and then we'll take it from there.
The crisis brought to the fore the challenge of an economy, the challenge an economy could face when it relies on a single commodity for most of its foreign exchange earnings and government revenue. The crisis also underscored the need for measures that will drive productivity in key sectors of the Nigerian economy, such as agriculture and core manufacturing. Productivity growth in these sectors are badly needed to insulate our economy from volatilities in the crude oil market and help in creating jobs on a mass scale, given our large and growing population. In setting the context at today's session, you'll observe that the CBN took a number of actions in the last 5 years to support the growth of the Nigerian economy, and these have helped in achieving the macroeconomic stability we see today, with inflation trending downwards to 11.37% from 18.72% in January 2017, exchange rate stability at current levels with considerable convergence, and reserves build up to current levels of over 45 billion compared to 23 billion in October 2016. Although we had hoped to achieve a lower level of interest rates, this became impossible given the normalization of monetary policy by the US and the over 60% drop in crude oil prices between 2014 and 2016. You will agree with me that the consequences of these unfortunate occurrences was a heightened inflationary pressure on the economy, and monetary policy had no option but to embark on a regime of tightening so as to rein in inflation. We also deployed measures aimed at supporting improved productivity of the Nigerian economy by restricting access to foreign exchange on 43 items that could be produced in the country, and also strengthened our intervention programs, which helped in restarting the flow of credit to critical sectors of our economy. As part of our interventions, we introduced our Anchor Borrower program, a program that helped to improve access to credit to smallholder farmers in our rural communities. Through our intervention programs such as the Commercial Agricultural Credit Scheme and the Real Sector Support Fund, we have enabled large agro-processors and manufacturers expand their operations, thereby supporting our efforts at improving domestic production of goods. Whereas these results are reassuring, I think it is fair to state that our task at building a stronger economy is far from complete, with the pace of GDP growth remaining very fragile and badly lagging behind population growth rate. Indeed, we are yet to see a substantial increase in credit in the private sector by our financial institutions. Our domestic industries, particularly high employment generating sectors like the textile and garment sectors, have to deal with rampant smuggling and dumping of materials through our borders. These challenges no doubt call for action by the monetary and fiscal policies through the implementation of policies, the spirit and letter of which must be respected by all. Furthermore, the rising volatility which we see today in the crude oil market, occasioned by the rapid increase in the supply of shale oil by the United States, and which has seen its production rise from 9 million barrels per day in 2017 to over 12 million barrels per day today, portends great risk to Nigeria's growth trajectory if we do not take actions that would wean us from excessive reliance on crude earnings for our survival. This means that we must strengthen our efforts over the coming years to stimulate growth and create jobs in critical sectors of our economy that will help insulate our economy from shocks in the global economy. In doing this, the Central Bank of Nigeria has recently been caught in a syndrome which we term the dilemma of monetary policy in Nigeria. Typically, for a nation to be seen to be prosperous, any citizen of that country would expect the following macroeconomic indices to prevail: a low interest rate regime, a stable exchange rate regime, a robust reserve position, a low inflationary environment, and lastly, an environment of full employment. In fact, I love this and would have less stress in monetary policy if all these are possible. But the question we should ask ourselves at this session is, in the Nigeria of today, are these all possible at the same time? Indeed, we are fully cognizant of the diversity of opinions of even some of you here regarding our actions or regarding our actions on the monetary policy side. Put succinctly, we have watched some economic and financial analysts through televisions and others through the newspapers say that to grow the economy and create jobs, the CUN must allow exchange rate to free float and also allow inflation to rise, while at the same time allowing interest rates to come down. We have also curiously observed that these analysts have often reached different conclusions from those of the CBN.
Godwin Emefiele, the governor of the central bank, expressing some of his initial thoughts at that weekend meeting. Tomorrow through till Wednesday, we'll let you have the views from policymakers and business leaders who are there. What are their thoughts and ideas for the central bank moving forward over the next 5 years? So we had a bit of a breather on Friday from the marketplace as the U.S. and Mexico seems to get their acts together, trying to prevent another window of very bitter trade wars. So that's one good news as the markets around the world through the weekend from the U.S. and this morning in Asia and Europe begin to trade this new measure of optimism around the trade fight between U.S. and its major southern neighbor. So let's put this to Juliana Olayinka, who is one of our business correspondents team and our team in the city of London from our studios there. Good to see you, Juliana. Hope you had a very great weekend.
I had a great weekend, Bosun. I definitely want to go on to US and Mexico, but if you allow me, we do have some breaking news here in the UK. First of all, the FTSE 100 has got off to a good start this morning. The UK blue chip index rose by 38 points, but the UK economy has shrank in April by the most in nearly 3 years. The UK economy is shrinking. This is according to data provided by the Office for National Statistics that just came out whilst you were on air. Gross domestic product, or GDP, fell by 0.4%, the biggest monthly fall since March 2016. That was before the referendum vote. That's a 0.1% drop in March. Analysts had expected only a 0.1% contraction. The GDP report also showed, as we've discussed many a times on your show, that UK manufacturing output has fallen by 3.9% month on month in April, after a 0.9% increase in March. Industrial production also dipped. There are so many mullings and data that we must go through, Bosun, but really Brexit paralysis is kicking in. Economists predicted just a 1% fall in industrial output, but it's fallen by 1.4%. I'll quickly go to currencies. The pound has gained, I think this was before this data come out, by 1.53 cents against the dollar to $1.27, but lost 59 cents against the euro at €1.12. So I'm sure by lunchtime we'll have more information for you. But breaking news here in the UK is that the British economy has shrunk by the most it has in 3 years.
This is going to be one head-scratching story for everyone on Market Street, number 10 Downing Street, and of course at the Parliament today, as the struggle for who becomes the next Prime Minister the battle continue between the main contenders and the laggards. So this is going to be everything for the marketplace as we speak. You talk about the FTSE 100, and even though it looks a little bit green at the open, it's beginning to become a little bit shaky. So do you think this is going to be not just for the economy, but for every ordinary Londoners and British people today looking at these very negative GDP numbers, adding to the global headache and the concerns about where we go with the trade fight, with Brexit, and of course, all of this ahead of what everyone is thinking, what happens to Britain, what happens to the EU?
Well, yes, both, and I think, you know, it's people are not exaggerating when they say Britain really is in a political coma. I think the reason why it was so kind of muted when Theresa May left on Friday was purely because who is actually going to be able to take up her mandate and get the British people out of Britain? Of course, there's an ongoing spat at the moment between Boris Johnson, who is the lead contender, the favourite. He's a staunch politician, part of the establishment, as you may say. He was the face of the Leave campaign. He was actually in court last week. I must say that the case has been thrown out because a lot of people said he lied, telling the British public that they were going to be losing £350 million every week if they stayed within the EU. Now, he is a hard-line Brexiteer, and there's a £39 billion divorce bill that Britain must pay the European Union if indeed they do leave, whether they leave with a deal or not a deal. Boris Johnson was given an interview on the weekend, and he said that Britain will not be paying that bill unless they negotiate a better withdrawal agreement with the EU. Emmanuel Macron, the French president, wasn't happy with that statement and said that, you know, there will be dark days ahead of Britain if they decide to leave and not pay the bill. So Britain is in a crisis. We spoke on Friday as well, Bosun, and we mentioned the job losses from the closure of the car plant in Wales. Analysts predict that another 60,000 losses will come from the industrial sector. It's becoming a real Brexit battle. It kicks on. But like I said, that breaking news here out of London that the economy has shrank the most it has in 3 years is definitely going to be picking up the pace over the next coming days.
Yes, Juliana, you know what the announcement always be from the cockpit if you are flying into troubled weathers. Fasten your seatbelt. You hear the sign. Fasten your seatbelt, everyone. We're running into some turbulence. That's the breaking news out of London. Thank you very much. Keep us in the loop in the afternoon. We'll check with you on afternoon. Business Incorporated show how the market is taking these negative GDP numbers in its chain. Juliana Olanyika from our studios in London. Let's give you what is breaking news right now here in Nigeria. The Securities and Exchange Commission has suspended tomorrow's annual general meeting of Owando Nigeria PLC. According to a press statement just released as we're on air by the SEC headquarters in Abuja, this was in pursuit of the court case brought against the regulator by the listed energy trader. The company's annual shareholders meeting is scheduled for 10 o'clock tomorrow morning here in Lagos in Victoria Island. Now the SEC says that meeting is being suspended until the court case has been heard. Now, let's cross over to Malabo in Equatorial Guinea to try and get a sense of what this week's annual general meetings of the AFDB group will be focusing on. As we told you earlier, these annual meetings will focus on how to use regional integration of the regional economic blocks to power the continent-wide economic integration and growth. That's what the president of the AFDB and, of course, the chairman, Akinwumi Adesina, will be leading others, hundreds and hundreds of other delegates to talk about this week. So this is one big story. But of course, part of that conversation is the electricity or power sector, which the continent needs very sorely for its fourth industrial revolution, or to be part of the fourth industrial revolution. Lade Araba, who was a former senior investment officer at AFDB Group and the managing director of Africa, is live to us from Malabo this morning. Good morning, madam. Thank you very much. We appreciate you holding on the fourth day on Skype to speak to us. So let's get this show started. Lade?
Yes. Good morning, Bosun. Thank you so much for having me. It's a pleasure to be here.
We appreciate your time. I'm sure you You landed safely. Thank you. So what's the atmosphere there? The talk about, you were a former senior investment officer with AFDB, so you have an idea of what AFDB is all about. So what's your thought about this year's topic?
So I think, the issue of regional integration is very important for Africa. Having 54 small markets is not competitive, does not create efficiencies. And so trying to push towards regional integration is a very important step in the right direction. As you know, the African Continental Free Trade Area has only been ratified by 24 countries, which means that we still have a bit of work to do to get the other countries on board. Now, when you speak about regional integration, it goes beyond, creating a common market and even harmonizing legal and regulatory frameworks. There's significant investments that are required in regional infrastructure to facilitate the movement of people, goods, and services. But the big question is, how are we going to finance these major projects? A lot of financing is going to be required. AFDB estimates around $174 trillion annually, with about 40% of that going into power generation. And that's really what blended finance is trying to accomplish, is to create bankable and investable projects that will be able to attract private investment at scale. And that is what we are focused on at Convergence, which is the global network for blended finance.
Yes, we need finance. We need to fix the continent's power sector. But speaking specifically to Nigeria, where you've done some work in terms of your ideas and thoughts and thinking about how to fix this power sector, what would you be hearing at these annual meetings, Alade? What other thoughts do you think, new thinking, new ideas for new and better results for Nigeria's electricity emerging power sector?
That's a great question, Bosun. And, I'll speak to some of the successes as well as opportunities. We know what the challenges are in the sectors, from the technical to the, regulatory, as well as the financing, but we have seen some positive strides in the right direction. For instance, the focus on diversifying the energy mix. We have a lot of solar projects that are being developed. We see efforts to increase embedded generation. We're seeing efforts around rural electrification, the installation of mini grids, and so on. These are all positive steps, and I think that we need to continue to work on that. At the same time, when you talk about, blended finance and its potential for the market, you look at a transaction like the Azura Edo IPP, which was really the first project-financed independent power plant that was developed in Nigeria, completed on time within budget, which, is unheard of in a number of jurisdictions. And Azura was possible because it was blended, and there was a lot of coordination happening between concessional capital providers, who are then able to pull in lenders, so on commercial terms, international banks, as well as some of the local banks. So if you look at the capital structure of Azura, it had a DFI tranche, which is provided by a series of DFIs led by the IFC. They had a number of credit enhancement instruments, so guarantees that were provided through the Ministry of Finance in the form of the put-call option agreement, as well as guarantees provided by IBRD, MEGA, political risk insurance. You had Standard Chartered Bank, which arranged the senior debt from a number of international banks. And very importantly, there was also about $125 million that was financed in local currency by local commercial banks. So that is one example in which, blended finance can be utilized to create transactions that are both bankable and investable, and ultimately able to pull in private investment at scale.
Ladi Araba, thank you so much. Let's check in with you before Friday to give us your thoughts on how this big meeting is progressing in Malabo. Thank you very much. Have a great day and a great meeting, the AFDB annual meetings. Thank you so much, the Managing Director of Africa and former Senior Investment Officer at AFDB Group. We're right back after the break. Business Morning continues.